Greetings and salutations. We'll be looking at a couple properties on the market today. We're going to look at what the mortgage payment is going to be for this particular property. Then we're going to look at your income and we're going to figure out what you can afford to buy. For today's example, this buyer will be a first-time home buyer. Currently they're renting and they're trying to buy a house. And they got no idea how much income is necessary for a particular property. Here I got Redfin open. As you can see, I've highlighted probably my favorite areas. I'm in a Portland, Vancouver area. I do not like to buy in Portland for obvious reasons and a different video someday, but I like to buy in Vancouver. I like to buy in Gresham, Fairview, pretty much east of Portland and south. I do like Milwaukee a little bit, but it's not on here. Happy Valley is nice. Damascus is nice, but it's a little bit further out. Analysis of the map and the areas will be at some other time. Today, our goal is to look at a couple examples. Doesn't matter where they are. It just matters how we navigate around them. Let's take before I jump in, here's sort of my filters. I'm sure everybody's used Redfin or Zillow before. I'm looking at properties anywhere up to 475. I'm looking at multifamily, townhomes, houses, whatever. But I do want 3 bedrooms and higher. And I want a bathroom and a half and more. I want at least 1,500 square feet. So after I've set what I'm looking for, what we're going to do here is open up. I don't know why this lot showed up. We're going to open up this one. This is the cheapest property. It's in Gresham. I know this area real well. I opened this guy up, and we got ourselves, a nice home, whatever. You can click through it, figure out if this kind of fits your needs. And the reason I'm kind of clicking through it, there's a couple things I'm looking for. As an investor, I'm looking for potential house hacking situation. We'll talk about what that is. It looks like this is a multi kind of level situation. I haven't even read the description. I'm just look at that ceiling. So as we're analyzing this, these photos, you can see there's going to need a little bit of work to get it nice and dandy. But if it's a conventional loan, most likely we won't have an issue. So I got definitely a split level. As you walk in, you got a down and you got an up. These are one of my favorites. So after we identify the property that this is a potential buy, if you're a smart buyer, you're going to go into this property with as least amount of money as possible. And we'll have other videos on ROI also. But in this particular example, we've identified that this is a good property for us to live in. And potentially we can rent part of this house out to somebody else. That's why split levels work really well. In this particular example, we know that the house is 315. It's fairly large, 2,900 square foot. We can come down here and we can use this the Redfin calculator, which is kind of clumsy to use in my opinion. We can find a mortgage calculator off of Zillow. There's 100 different tools to use how you would calculate. It's up to you. But if you were to use this one, don't go off the defaults. You want to plug in the appropriate information here. Check out my other videos of what the interest rates are doing and where they're at right now. Let's just say that you're buying this property with 6%. If you're a first-time home buyer and you want to do 20% down, that's probably not a good idea. I will explain to you why in later videos. Let's just do 5% down. Property taxes is pretty accurate. It tries to pull from the county. Mortgage insurance, this is not accurate. I will show you that in a second also. And homeowners insurance is fairly accurate. Here in the northwest, the Portland, Vancouver area, they're quite low. Actually, let me show you another tool that I like to use. This is something that I built out. And we do 5% down. Let's just say monthly insurance, $60 a month. Now, this mortgage insurance gets calculated based on an MI rate, is based on your credit score, based on a couple of different things. HOA, thankfully there's no HOA. Assets needed. So in this particular area, let's just say that you're probably going to need, let's just say about $10,000 for closing, prepaids, escrow, etc. I have a whole different video on closing costs. Again, this video is going to be a very broad overview. So at this particular, with these settings set, these numbers, it looks like your monthly mortgage payment is going to be, let's see, let's make sure that our taxes are correct. Tax history. So these are the taxes for 2021. I would probably add another 100 or something in there. So I would just say, 4650 a year. So we're going to do equals 4650 divided by 12. That gives us a monthly. So with these numbers set, here's your monthly loan payment. Includes everything. So every month you're going to make this payment. This is going to go into your escrow, the tax. Insurance is going to go into your escrow. And PMI is going to go into your escrow. And then those distributions will be made on your behalf. Here's our income. And this is what we're going to focus on. With these numbers set, again, DTI is determined by your credit score, your FICO, all those things. What you're approved for, your loan officer can tell you. The magic numbers here is if we're going to run this as conventional with 5%. If you have credit score over 740 and you're in relatively decent standing, we've been able to approve as high as 49.9. So what that means is you can easily pull this if you're making five grand a month, and that's gross income. We'll talk. I have a whole segment on income, several videos actually. So here we're just sort of going to play around with some numbers here and figure out what is the base minimum that you're going to need. 47.50. So after you play around with the numbers, if you're making 47.50 gross a month, and this is assuming you have no other debt, zero. You don't have any credit card debts. If you do, you need to pay them off. You don't have an auto loan. You have anything like that. All of a sudden, if you have an auto loan and you're paying $300 a month, guess what happens? The front end doesn't change. The back end sure does. So remember, we need to keep this baby below 50. Sometimes it's only 45. Sometimes it's 43. It all depends on your situation. So in this particular case, this person does have an auto loan. So either A, when you're closing on this house, you need to pay it off. We can null the auto loan if there's less than 10 installments left. But assuming you just got it, how much income do we need at that point? Well, we just need to add some income over here. So I just added $300 that we lost on auto loan. We added it here. And it's in reverse. So say you make $7,000 a month. You're well above your DTI. And you do have an auto loan, which is totally fine. So how do we find out what your max budget is? That's quite easy. And we start plugging the numbers on this side of town, right? Say you're looking at a house at around $500,000. You see how automatically we jump ahead. There's more efficient ways of doing this. I have other tools, but I'm just showing you a bare bones exactly how we can easily calculate exactly what we're making. So after I played around a couple numbers, I realized, all right, so if I'm making $7,000, $450, that's my budget. That's what I can go and shoot. Anytime the bank gives you a pre-approval for $450, keep in mind, this is not what they're giving you a pre-approval for. They're giving you a pre-approval for your monthly loan payment. And in this case, this is a total. You should probably rename this. It's a total monthly loan payment. And on a home this big, taxes are probably going to be higher. So you got to be careful. You got to come in here and maybe, up that. Insurance, possibly a little bit higher. Notice that the PMI gets higher. The MI rate doesn't change, but the PMI, because that is the loan amount times the MI rate, and we divide that by 12. That's how the MI rate gets calculated. You can see it here. Again, this is something we'll talk about later. So with these numbers, all of a sudden we're above our budget. So this would not qualify anymore, just being that much higher. So then you're going to need to be very careful. Maybe you can find it, monthly insurance for $70. That still doesn't get us there. If you do find it for 60, man, you're cutting it close, but you're right there. But guess what? What if you find a house and everything lines up and there's an HOA for $50 a month? Well, you're no longer approved. So this is where people get really confused, saying, "Hey, I'm pre-approved for 400, 450, 500." Before you make any offers, number one thing is let's look at the property. Every property is individual. Same thing goes the other way. If you were approved, in an area where HOAs are high, insurance are high, and these properties are in the 400 range, and then all of a sudden you want to push your budget, we have those calculations to make. So in essence, this is how we look at what the mortgage payment is. This is what we look at. This is where we look and find out what our income is and what the banks potentially will loan us on. I hope you found this useful. I can do all sorts of calculations. Please leave your comments below, and we'll go from there.